Donald Trump just proposed a 50-year mortgage to solve the housing affordability crisis. Now, Dave Ramsey is going to absolutely hate this, and honestly, they're both right and they're both wrong, depending on who you are. I'm Beny. I've been a mortgage advisor for over 21 years. I've helped over 2,700 families with financing, and today I'm going to break down exactly who should consider a 50-year mortgage, who should run from it, and the strategy that Dave Ramsey and Trump are both missing. By the end of this video, you're gonna know exactly where you stand on this debate and what it means for your financial situation. Let's dive in. All right, first things first, what is Trump actually proposing here? On November 8th, 2025, Trump posted on the Truth Social suggesting 50-year mortgages, and FHFA Director Bill Pulte confirmed they're indeed working on the 50-year mortgage, a complete game changer. Now, currently under the Dodd-Frank Act, passed after the 2008 financial crisis, mortgages were capped at 30 years. The qualified mortgage rule doesn't allow 40 or 50-year terms. For this to happen, they'd have to change federal law, or lenders could offer them as non-QM loans, which typically comes with a higher interest rate. The pitch is simple: lower monthly payments to help with affordability. Now let's look at the actual numbers on a $500,000 mortgage at 6.5%. 30-year fix, $2,548 a month. 40-year fix, $2,363 per month, and a 50-year fix, $2,277 per month. So you're saving about $271 per month by going from 30 to 50 years. That's the trade-off. $271 a month for 20 extra years of payments. But here's what the headlines aren't telling you, and this is where it gets really interesting. Now, if you know Dave Ramsey, you already know what he thinks about this. Dave's entire philosophy is debt is dumb, cash is king, pay off your house as fast as possible. And you know what? For most first-time homebuyers, Dave is absolutely right on this one. Here's why. The average first-time homebuyer in America is now 40 years old. Let that sink in. 40 years old buying your first home. And if you're 40 and you take out a 50-year mortgage, you're paying it until you're 90 years old. The average life expectancy in the United States is 76. Most people will literally die with this mortgage still on their house. We're not talking about paying off your home anymore. We're talking about generational debt that's get passed to your kids. But here's the part that really bothers me. You're building almost zero equity in the early years. After 10 years on a 50-year mortgage, you've barely made a dent in the principal. But keep in mind, if you live in a market where homes appreciate more than others, you do build equity via homes values increasing. Dave Ramsey would tell you this is exactly the kind of debt trap that keeps people poor. And for a primary residence buyers hoping to own their home free and clear someday, he's 100% right. Now, the American dream used to be owning the home outright, building wealth, leaving an asset to your children, not dying with a mortgage, that passing debt to the next generation. Okay, but here's where I disagree with Dave Ramsey's one-size-fits-all approach. See, Dave treats all debt the same, but there's a massive difference between consumer debt on depreciating assets and strategic debt on appreciating assets. The wealthiest people I work with, they don't pay off their mortgages. They use debt strategically as a tool to build wealth. If you're an investor, a 50-year mortgage could be an absolute weapon. Here's why. Let's say you buy a rental property for $400,000 with a 30-year mortgage. Your payment's $2,038 a month. With a 50-year, it's $1,822. That's a $216,000 a month difference. If the property rents for $3,000 a month, you just increased your cash flow by $216. That's $2,592 more per year in your pocket. That's why you can use to buy another property, build your portfolio, create more passive income streams. But here's the thing, you were never planning to pay off that investment property anyway. Most investors refinance or sell within 7 to 10 years. The equity paydown doesn't matter because you're banking on appreciation and cash flow. Plus, you're getting all the tax benefits through mortgage interest deductions and depreciation. That's how you build actual wealth, not by paying off your mortgage on appreciating assets. Same thing if you're doing short-term plays in hot appreciation markets. So if you're buying in Southern California or Seattle and they're planning to hold for 5 to 7 years, banking on 10 to 20% appreciation, who cares if it's a 30 or a 50-year mortgage? You want the lowest payment possible to maximize your monthly spread. Dave Ramsey's approach works great for getting out of consumer debt and living within the means, but his blanket all debt is bad philosophy, that keeps people from using one of the most powerful wealth building tools available, strategic leverage on appreciating assets. But here's the real issue with Trump's 50-year mortgage proposal. And that is what both Trump and Dave Ramsey are missing. This doesn't actually solve the affordability crisis. In fact, it might make it worse. Here's why. A 50-year mortgage increases the buyer pool. More people can qualify because the payments are lower, but it doesn't add a single home to the market. Economics 101. When you increase demand without increasing supply, what happens? Prices go up. This is the part of what led to 2008 financial crisis. We made it easier for more people to qualify for mortgages without addressing the fundamental supply shortage. We all know how that ended. So that $270 a month savings, it disappears when home prices jump another 5 to 10% because of increased buyer demand. The only real solution to the affordability crisis is build more homes, increase supply. Everything else, whether it's a 50-year mortgage, down payment assistance, first-time buyer credits, all of that just stimulates demand and drives prices higher. Trump's proposal is a band-aid on a bullet wound. It might help some people in the short term, but it doesn't fix the underlying problem. So listen, if you're a first-time homebuyer watching this and you're thinking, okay, Beny, you told me not to take a 50-year mortgage, but I still can't afford a home in today's market. What am I supposed to do? Here's what I'm actually doing for my clients right now that's working. Homes are sitting on the market. Sellers are motivated, days on market are increasing, and sellers are getting nervous. Instead of taking a 50-year mortgage to save $270, negotiate a seller credit to buy your interest rate down. Here's how it works. You ask the seller for a $10,000 or $15,000 credit at closing. You use that credit to buy down your interest rate by 1 to 1.5%. That gives you the same monthly savings as a 50-year mortgage, but you keep your 30-year term and you actually build wealth and equity faster. I'm doing this for clients every single week. It's a negotiation problem. It's not a mortgage term problem. This is where having a mortgage advisor who actually understands creative financing makes all the difference. There are strategies available right now that most people don't know about because they're working with lenders who just push whatever's easiest. All right, here's my final take. After 21 years in the business, a 50-year mortgage is a tool. And like any tool, it can build wealth or destroy it depending on who's using it and how. For investors, this could be a powerful addition to your financing toolkit. Use it strategically. For first-time homebuyers hoping to own your home someday, this is a trap dressed up as an affordability. Don't fall for it. Dave Ramsey's one-size-fits-all approach doesn't work for everyone, but neither does Trump's policy proposal. The truth is, everyone's financial situation is different. The 40-year-old teacher buying their first home needs a completely different strategy than the investor building a rental portfolio. Listen, my job isn't to tell you what Dave Ramsey thinks or what Trump is proposing. My job is to understand your specific goal and build a financing strategy that gets you there. So here's what I want you to do. Drop a comment below and tell me, are you team Dave Ramsey, all debt is bad, or team investor, debt is a tool for building wealth? And more importantly, are you buying your first home or are you building an investment portfolio? I read every single comment and I'll respond with my thoughts on your specific situation. Thank you for watching and I'll see you on the next one.